we are talking about the next part, that is PBIT and EPS analysis and maximization of shareholders' wealth. Now, PBIT means profit before interest and tax, and EPS stands for earning per share. So, we are analyzing how these two terms I need to analyze so that these terms are used for deciding what is my optimum capital structure. The profit before interest and tax is a clear profit because if I apply the interest and taxation, then the weightage of interest or weightage of taxation is not calculated. Why this weightage is required? This weightage is required to understand whether I'm giving higher interest outside and that's creating a loss to me, or the interest which I'm sharing are not at that level. Because if maximum borrowed capital is there, then higher interest rates are need to pay. Whereas earning per share is based on market pricing, where how much profits are distributed to shareholders and how much is as the leverage. So basically, PBIT in EPS analysis, I'm trying to study the income generated for shareholders and income distributed as leverage to outside borrowings. So let's understand the basics. Profit before interest and tax, it is nothing but an amount which excludes financial decision, that is interest, taxation, and dividends, whatever the paid. So this is a clear profit only we can say arise from our operational activities. It includes some part like depreciation or some part like non-business income expenditure, but it particularly not adding the cost of capital. That's why it is earning before interest and taxation. Now, why EBIT is important? EBIT is important because it clears away non-operational factors and shows effective performance of a business. And I can compare this with payments and taxes. So most of the time after EBIT, I have to deduct interest and tax, or I have to deduct dividends and tax. So what is the capital support or what is the admin charges I need to pay? They are not directly linked with my performance. So if instead of earning after interest and tax, I consider that is purely profit which a company want to retain. But difference between EBIT and earning after, that is EAIT, I need to manage. And if I manage this difference, then my earning per share will be highest one. So when I want to take any decisions, I need to consider earning before and after. And that before and after gap is too large, then I'm not able to generate the income. Now, how much to retain the profit and how much not to retain, that will be decisions as per the board of directors because they will consider declaration of dividend. But at least when I'm concerned about giving leverage or giving interest, I should see that minimum interest is given because if I give higher interest, the margin available for distribution will be lower. So for making decision, what should be a capital? I need to understand here two factors, which is interest and tax. And by considering those two factors, I need to take a call. What should be structure of my capital? So in this chapter, we need to analyze the difference between EBIT and EAIT. So this after and before, when I consider, I can calculate operational factors that reveal. Secondly, whatever the things I'm having, they will be giving me accurate performance because interest will be varying or taxes will be varying based on my profitability. But in all this, I need to understand how much inside operational improvements, then I should only consider EBIT and not EIT. But the difference between them, it need to be maximum if I want to increase value of my shareholders. Now, what is earning per share? Earning per share is basically how much income is earned by shareholders. If I say in normal, the formula for earning per share is profit after interest and tax divided by number of shareholders. So it is earning after interest and tax divided by number. So if my earning after tax is 2000 and there are 10 people, then 2000 divided by 10. So each person will get 200. So earning after tax will be available. So that will be 200. So when my earning after tax is maximum, when I'm able to manage my interest and tax. So EBIT talks about that I should minimize my interest, I should minimize my taxation part, and that will help me to generate more and more earning after tax. And when I have more earning after tax, definitely it will help me for earning per share maximization. And if earning per share is maximized, my shareholders will be happy. So basic concept is instead of just talking about own capital, borrowed capital, this concept talks about how much money is retained and distributed to shareholders. Now, what is crucial for investors? Earning per share is a signal that company is performing steady and strong. It is an indicator that company is achieving returns for investors rather than just paying debts. Similarly, valuation of earning per share helps to calculate formulas like P ratio, 52 weeks high lows, and these are nothing but benchmark tools to take investment decisions. So, earning per share is very crucial to understand steady growth, profitability available to equity owners, and to make an investment decisions. Now, those who are doing technical analysis, please remember EPS is a base to derive the values for cash position and cash out position because earning per share is a strategic indicator which gives a signal whether the company is performing well or a company is having some limitations. Because here understanding EPS is very easy. Profit available for distribution is 5,000 and there are 1,000 people. Then each person will get 5 rupees as a reward of holding shares. Now EPS is not means you're paying. It is just means how much you are going to gain. So it is combined two things, paid and unpaid. But if the indicator is high, company is doing good. If indicator is low, company may be in a situation where maximum interest is given. So if my earning before interest and tax is 10,000 and earning after interest and tax is 5,000, then each person, if 1,000 people are there, they will get 5. So let me illustrate again with the whiteboard and then I'll come back to the PPT. So my just a minute. My EPS is equal to earning after interest and tax, and this will be divided by number of shareholders. So the formula is earning after interest and tax divided by number of shareholders. But for earning after interest and tax, I need to find out earning before interest and tax minus interest minus tax. So here, how much is interest and how much is tax? That will help me to find out this value maximum. And when this value is maximum, then the earning per share will be maximum. For example, if it is 5,000 divided by 1,000, then per person it will give me 5. So earning per share will be 5. Suppose earning before interest and tax is 10,000 and both interest and tax they count as 5. So the amount available will be 5,000. Now in this case, I cannot control number of shareholders. I cannot talk directly control or earning before interest and tax. But about interest part and taxation, I can make a planning by deciding how much to be my own capital and how much to be my borrowed capital. And hence, in this case, I need to understand difference. Suppose this difference, if I take other way, my EBIT is 10K and interest and tax is only 2K. So what I get is 8K EAIT. Then earning will be 8 rupees. Hence, if my interest and tax part is managed properly, my earning per share will be more. And in reverse, suppose this amount of interest and tax increases, then the profit available after interest and tax will be declined. In that case, my earning per share will go down. When my EPS will go down, the investor will lose the confidence in my company and they will not be happy. So I need to understand the profitability and interest, both the complete tools. How much out of my capital is interest part I require to pay, and how much out of my capital the taxation I'm paying. And that's why EPS is one of the fundamental indicator of financial performance. And based on that, I need to take a decision about valuation and structure of capital. Now, I already explained the relation, but let's revise again. This analysis is a tool that talks about your earning per share. It talks about difference between your earnings from business activity and profit available. As I said, in case of EPS, I required EAIT, that is earning after interest and tax. So for this, interest and tax part should be reduced. Maximum part reduced, my earning per share increase more. That will give more benefit to my shareholders and their more confidence in company. Once equity owners' confidence is raised, their cost of capital will go on decline. So I need to understand these values. Now, how this will make an impact? The capital structure is having depth. So maximum depth will interact maximum interest. So maximum interest, if I'm repaying, then the income which I generated will not be available for my own source. So in this case, the maximum income generated, I should make sure that I'm retaining in a business. If I'm returning maximum in business, then I'm not paying heavy taxes because tax is not avoidable. It is, if I plan, I can reduce, but at least interest part, because I'm borrowing capital. So if I'm borrowing a capital, I should take care the interest part should not make impact on my earning capacity. That is on benefit to the shareholder. If interest part is maximum, for example, here I need to consider the relation between equity and debt. If equity is more than debt and the interest part is favorable, then this relationship is accepted. But if reverse, if debt is more than equity and even the situation is favorable that I require to pay less interest, then I can have debt. So whether I should have equity more or debt more, both the values I should decide based on something called as my interest. So how much is debt financing? That will decide equation of E and D. It will 60-30, 70-80, or 80-20, 45, 55, anything. But I need to understand it should not be in such a way that it will create a burden about paying more and more debt. Because when I'm paying a debt, I also require to pay some additional taxation. Whereas if I plan properly for interest, if I plan properly for taxation and reduce their influence or reduce their burden on my profitability, the income available for shareholders to distribute will be more. As I given in example, if 5,000 is earning after tax and 1,000 people are there, they'll get 5. But reverse way, if my interest and tax is reduced, it is only 1,000. So 9,000 amount is available. Then earning per share will increase from 5 to 9. That is 4 rupees per share. So in case when I doing capital structure and if I follow EBIT and EPS analysis, then I should talk about how much is earning per share available. The maximum share is available, then the people are having interest and faith in company. So this is strategic decision and one has to account on different parameters. As per this, you need to calculate the break evens. For example, if you see in a diagram, I had to find out at which point of earning per share the value is maximum, at which point the value is minimum, and at a break even, I have to maintain my capital. So theoretically, if my earning per share is if my earning per share, if I draw a dotted line, it is here and here. What I find is a break-even situation. Whatever the red mark area, if I design my capital structure, that is a combination my E and combination of my D, then in both the cases, I'm going to make losses. I'm going to have less income. But in reverse way, if I plan anything after this, then I'm going to have more and more share value, more and more EPS, and so on. So I have to plan my share value, my market price, and my structure of capital in a such a way that beyond this break-even point, I'm able to exit. Because here I can generate profits, but whereas if I decline, I'm not able to generate any profits. Please just read the slide. I'll wait for 2 minutes. Any doubt, you can ask me. I guess no doubt. I'll move further. Now, if my sales revenue is 2 lakh 2.5, cost of goods sold is 1.4, then after operating all these expenses, my valuation, that is corporate tax, will be 30K. This figure represents mid-sized company. Okay. So first I'll calculate the profit. So after minus everything, I get a profit of 70,000. Then I find out net income, that is EBIT minus interest minus tax. So even though I earn 7 lakhs, I am having only 4 lakh 70,000 available for shareholders. Then my earning per share for 10,000 shares will be 47. In this case, if suppose instead of 2 lakh 30,000, it is only 10,000, then out of 7 lakhs, 6 lakh 90,000 will be available and my EPS will be 69. So here I find interest part is majorly. So if I consider almost 25% debt I'm carrying. So I need to understand here this interest part, how I'm going to minimize. Because if I calculate of 2 lakhs, approximately around 25 to 30, this percent is there. If it is zero, then my answer will be here 6 lakh 70,000 and it is 67 earning per share. In reverse way, suppose this figure, this figure becomes 5 lakhs, then my net income will be 2 lakhs and my earning per share will be 20. So the combination of borrowed capital and my own capital, I need to find out and then I can decide what is my capital structure. So as per this theory, capital is divided as equity and debt. What is the relation between these two is nothing but how much interest expenses and how much tax I'm going to pay. So net income and earning before interest tax, if I calculate difference and if I make a formulas, I can talk how much is interest should be there, how much debt should be there, and I decide how much capital should be there. So any doubt in this calculation part? Let's move further. As per trade-offs of EBIT, I need to take more leverage if my earning is higher and trade-offs are low. But where my already interest or borrowings are on higher side, then in that case, I need to take a call that how much revenue I need to give as a value to the shareholders. Because if EPS is lower down, it will decline the confidence of shareholders. It will not give value to my firm, and people will not be more attracted for investment and decision making. EPS is also considered as a benchmark for scrutinizing the risk associated with the business. So if less EPS, it will indicate a risky profile of a company and it will not be helpful. So for any concerns, I need to take care that EPS should be higher. Now, how EPS should be higher? I need to check EBIT volatility and make it such a way that interest part is reduced. Now, what are limitations of this analysis? This analysis never gives a clear decision because they do not follow a structure or a theory or a clear format. This theory only proposes strategical analysis, or this theory is only presenting something called how should be capital. But this theory lacks in declaring how much should be debt and how much should be equity. Mostly, this theory advocates that your earning per share should be maximum and you should invest or you should have capital structure which gives maximum EPS. But how to achieve it is missing. So it has decision making clarity, but it lacks in complete decision making clarity. Similarly, it gives insight about leverages, that is debt value. It talks about how debt should be managed, how debt should be calculated, and how I should take the efforts to minimize the debt. It also gives importance that how much wealth creation is done for shareholders, and maximum wealth creation, maximum gain will be achieved. So, as per this theory, not only profits but also earning per share when it is maximum, then in that case, the capital structure is optimal. If EPS is lower, then even though my operational performance is good, the earning per share is declined, it will not give any value or benefit. So I will always concentrate on interest part and EPS in this theory. Now, when you talk advantage, there are certain limitations. Earning per share has conceptual limitations and the same follow here. A market focused price is always a emotional price which decides on certain other parameters which are beyond control. And that price cannot be always considered the benchmark. Similarly, always ignoring the debt will not be a profitable situation. In current market price, it may be not welcome, but future forecastings are limited. So it has only a limited focus to understand in current market price. Future expectation or future changes are ignored by this concept. Third, how to mitigate or how to plan for taxation is an internal capacity. One cannot just merely decide that I will do this, my tax will be reduced. Or if I do this, my interest part reduced. It's a trial and error. And many times when it is startup firms, I cannot compromise on borrowing because for startup, I required funding and I required money for the same. And in that case, I need to have more capital and I can take a risk of having higher interest part because when firms are growing, their interest part is growing and gradually when they surpass certain limit, then in that case, the capital part will be reducing debt part. I mean, the debt part is reduced, ultimately interest part is reduced. Now, I just want all of you to read this and if in doubt, you can just ask. I'll just zoom it for your purpose. So I have bonds with 6% interest, then my EPS will be impacted. But if I have more share and no bonds, then my interest part reduce, then earning per share will be increased. So when I plan for debt or equity, I plan for 5%, 6%, 8%, 12%, or zero. I need to take a call based on how much is EBIT and EAT analysis is there. So as per this approach of capital structure, I have to follow a structure which integrates low debt payments. It integrates a combined option where there will be balance of equity and debt in such a way that it will not impact dynamic of my capital, but it will generate more and more earning per share. So ultimately, This theory and is a policing that you should not borrow that much money that will impact your profitability or income level. You should only borrow a money which is a parallel source but not impacting. Even though it not saying no to the borrowed capital, but as per this, borrowed capital should be equated to the amount up to which your profit available for shareholders is not disturbed. If your profitability is hampered by percentage of interest, you should strongly avoid that because that combination of equity and borrowed capital or equity and debt capital will not make a growth. It will generally only influence and give help that more and more debt. So, how much to borrow, when to borrow, I need to take a call based on the combination of equity and debt. And the parameter is earning per share. So this is all about EBIT EPS analysis. If any doubt, you can just post in a message or ask me. Now this was the last approach about capital structure, but there are certain theories which are part of your syllabus. So let's talk about that theories. This is the last part of your second unit, ROI and ROE analysis to check about investment performance. Now the difference between I and E, that E stand for return on equity and I stand for return on investment. So when I'm investing some company, I have two options. I can be borrowed capital or I can invest in own capital. So based on that, the requirement of analysis will change. The return on investment, it morely talks about when I'm investing in any companies, it combines return on equity as well as return on debt capital which I invest. Whereas return on equity only talks about how much money I'm able to generate or what is my earning as share investment. So ROI is a measure of performance that how much I earn after I invest something. For example, if I purchase shares of 100 rupees and I'm getting dividend of 10 rupees. So out of 100 rupees share investment, I'm getting 10 rupees. So percentage of return is 10%. Now this 10% will be called return on investment. If it is my equity value, it's called return on equity. If it is investment, it is called as a return on investment. So technically, ROI is a measure of profit or loss or gain or income with related to the cost of investment which I have made. What is the formula for ROI? There are two methods. First, profit, sorry, income divided by cost into 100. And second is firm's final value minus initial value divided by cost into 100. Now, if I don't have income, but value of firm can be analyzed. That is change in value, that change in goodwill, then the second method is followed. But normally, when I know what is my returns, I can follow my first method. Now, please remember here I'm just analyzing how much is my income, and then I'm going to calculate how much is my cost. In this case, the end value and initial value, that is nothing but my return, are calculated. For example, if my returns are 50 and my cost is 40, so in this case, 0.80% is ROI, that is 80% income is generated. Let's talk about example. If I invest 10,000 in company, after 1 year, the investment become 12,000. So when I invested, it was 10,000. Now the value of investment 12,000. So what is change in investment? So over the year, 2,000 income is generated, and I invested how much? 10,000. So 2,000 on 10,000, it will be 20%. And now the ROI will be 20%. This means I can earn rupees 20 for amount of 100 invested. So if I want to take a decision whether I should invest or not, then based on ROI, I can take call. So it can be first method or second method of calculation, but I can take a call whether it's a profitable or not. Any doubt in this calculation? Okay, we move further. What does a negative ROI means? When ROI is negative, it indicates a loss. And when it is negative, I have to ensure that it is minimum figure, not maximum. Because when it is a maximum, it will give maximum loss. For example, if initial investment is 10,000 and final value is 8,000, then my loss is 20%. But if initial investment 10,000 and final value is 5,000, so my loss will be 50%. So when it is negative returns, I need to take care. The value should be lower side, it is good. Value on higher side, it is not accepted. It is not giving profitability. Now, there are different alternatives how I can go with. That is compound method or simple method. So this is just an change in methodology that I can go with the time value of money. I can go with the compound method or I can go with the simple interest method. Otherwise, the concept remains same. So please read the slide. If any doubt, ask me. Otherwise, I'll move further. Any doubts? Okay, we'll move further. Now, what is return on equity? It is a measure to find out how much earnings are available for equity owners. It is an insight study to analyze how much benefit is available. It is calculated by formula income divided by shareholders' equity into 100. So we'll directly go to the formula. Okay, I've not given the formula PPT. So let's illustrate here itself that my earning after interest and tax, that is EAIT, divided by my equity capital. Okay, I'll better It is EAIT divided by, so I can say it is a formula where earning after interest and tax divided by equity capital into 100. So in case my equity value is more, then return on equity will be lower. And my earning after interest and tax, if it is positively high, then it will go more on ROE. So if my return investment and return on ROE is higher, in that case, for such investments or such valuation of capital, I always prefer because that are giving me returns and avoiding risk. Now let's compare about equity and return. Equity is a smaller aspect which is a part of return on investment. So it is not majorly covering the dimensions of investment as total. Whereas equity just focused on ownership valuations because it gives a direct ownership and maximum risk. So it will help me to find a capital structure and proportion based on when I compare return on equity and return on investment. If return on equity is less, but return on investment is more, it means profit is more distributed to the outside people. But in reverse way, if ROI and ROE both are high, that means maximum profit is retained in the company. If maximum profit is retained, it means I'm going for the expansion or any other projects. Similarly, if ROI is more but ROE is less, it means I have buyback some of debts and that restructuring is benefited. So I can take a call based on difference of ROI and ROE, that what is the position of equity and overall investment. Because when I say ROI, it combines equity plus debt. And when I say ROE, it is only equity. Now we'll take a case study of a sheep farm. Initial investment is 50,000. He has returned 70,000. So increase in investment is 20,000. So for him, return on investment will be 20,000. Sorry, return on investment will be 20,000. For 50,000, the 20,000 will be approximate 40%. So if I compare both the things, what I find that even though my equity was 70,000, here I get ROI 40%. So simple ROI can use that firm's profitability on initial investment is good. But here he has invested by own money and borrowed money. This is not clear. So if I consider EPS and ROI analysis, I can get a better decision whether and how to control. Now, what are limitations? For all theories, the common limitations are critical to understand, not practical, and limited visibility because they involve technically calculation part. So same risk ignorance, calculation, financial engineering, these all nothing but limitations of these analysis. Then how I can maximize my ROI and ROE? Let's talk. First, I should reduce my cost part. I should emphasize on reduction of my expenses that will generate my more profit and that will help to go with more returns. Secondly, I need to manage my investment such a way that maturity is extended and interest payable is reduced. I should focus on selection of projects that will generate lower leverages rather than more debts. So considering all this, I need to make a strategy about my capital structure. So in short, as per this concept, the capital structure should be decided where ROI and ROE they both are maximum. If in case ROI is higher and ROE is weaker, then my debt is taking away money. I should restructure debt. But whereas ROI is normal, but ROE is less, then I need to also reframe my equity valuation. So I need to analyze both the things. So this is the last theory of capital structure. Anybody's any doubts? Anybody's any doubt? Now, in the last part of this chapter, we'll just summarize. It is what are the general guidelines to have the balance between capital structures about growth, risk, and flexibility, because these all are essential for my business. Capital structure is a combination of different mix of equity and debt, depend on my strategy, depend on source of finance. It is a combination of own capital and borrowed capital in proportion to suitability and availability of funds for my business. Why capital structure is important? Because the cost of capital has long-term impact and it always directly correlates with the risk profile. If my management is poor, it will impact on my returns and it will also impact towards my progress. It will not generate any income, but rather it will become a burden to my organization. Less capital or excess capital is always hampering growth speed which my business can achieve. Similarly, the cost of capital in excessive of my investment will fall lapse in strategy. And if I have excessive capital cost, then that will hamper growth and speed of my business progress. So I should have optimum capital structure, giving average risk, more flexibility, and less cost that will enhance more earning and more returns for my shareholders' value maximization. So for this, I need to find out some ratios which are set as a benchmark. First is debt to equity ratio. The formula for debt to equity is debt divided by equity into 100. When this ratio is proportionately 50-50, it's ideal. But when debt is higher and equity is lower, my earning per share will be lower, and that is not welcome. Similarly, if weighted cost of capital ratio we use as a benchmark, then in that case, optimum weight allocation should be the equity capital because they are the ultimate owners of company. And if I use just a debt ratio, that is how much debt, interest divided by debt into 100, then I should ensure not beyond 25% the debt should fall lapse. So these are first three indicators to find capital structure. And the common purpose is that I should borrow that much money which will not impact my growth and wealth creation for shareholders. So if I have balancing between debt and equity capital, I can take ownership advantage and I can also take advantage of profitability. I cannot compromise on lower cost and I will have more flexibility. So, based on tax advantage, controllability, adaptability, cost, and flexibility, I need to find balance for my own organization in debt and equity. Now, what are general guidelines? First, find out the tax advantage, find out the different schemes which will give me benefit. If I take a debt, what are the schemes? If I have my own capital, what are my schemes? And then decide whether it's a debt or equity. Second, find out your financial flexibility about repayment, about you using the debt, and about taxation or interest part in the debt. If it is favorable to you, take a call about own equity or borrowed debt. Third, if you're not able to maintain the returns or if you lapse in performance continuity, in that case, don't take a risk of higher debts. But if your performance integrates higher returns and continuity, then take risk of returns. Always focus your objectives and strategic decision based on combination of cost of capital, that is debt and equity. When you're doing financing or refinancing, your aligned target should be reduction of repayments and maximization of shareholders value or maximization of firm's value. And this will help for more good capital structure rather than just focusing on numbers like Budel Miller and operating and net income approaches. Also, based on type of industry, whether it's labor intensive, capital intensive, or inventory intensive, or it's more scientific or service type, I need to take call about combination of different concepts. So practically, when I'm planning for the capital structure, I should think about lower debts, stronger cash flow, and favorable credit position where my returns are higher, my expenses are low. Similarly, when my borrowings are there, I should focus on flexible, low interest rate borrowings which are not having any collateral existence on my company assets. And if I fall to raise the capital with normal interest rate and loss of any regulatory changes, then quality limitation will not be there and my business will perform better. This is a short analysis of capital structure. Please read for 2 minutes. I'll wait for 2 minutes. Any doubt in this? If no doubt, let's move further. So if I want to set a strategies, this is an example that how can I progress? I have to plan this way. This is not part of a syllabus, just an example I'm showing. So as per the last approach, EBIT, debt ratio, and WAC, that is debt ratio, debt to equity ratio, and weighted average cost of capital, I need to monitor in such a way the values will be generated. If suppose out of these three indicators, two are positive, I'm taking the key decisions. But if less than two are positive, I should avoid the capital decision. So what is the capital structure? I should consider debt to equity ratio, debt ratio, and weighted average cost of capital. Having this ratio positive indicates my earning capacity and wealth maximization, and this will be recognized as optimum capital structure. So when I want to plan the capital structure, I need to first analyze what is my financial flow, what are my burdens, what are my risk profiles. Then I have to finalize what maximum and minimum limit of borrowed and owned capital. Based on that, I have to decide a strategy from where I can take the capital or where I can get a finance for my capital. And after that execution, I need to review whether the planned capital and actual capital I'm able to go with three terms. One, return on investment, return on equity, and the debt burden which I'm carrying. So, in conclusion, capital structure is an art based on your financial expertise and your financial goal. Depending on type of business and risk profile you're going with, the speed you're going with, the nature of product you're going with, or the type of market, you can decide a borrowed capital or own capital or a combination based on your target motivations. So, this all about capital structure theories and meaning of capital. If anyone doubt, we can discuss or you can go for the next session. Since no doubts, please go with the next session. Thank you.